Constellation Energy, or CEG stock, announced a record deal to restart the 3 Mile Island nuclear plant, selling the power to Microsoft to power and fund its AI. And this is a big deal because 3 Mile Island previously experienced, back in 1979, it was the scene of the nation's worst commercial nuclear accident. What you're talking about is a partial meltdown. Hey, who doesn't have meltdowns from time to time? No, but in all seriousness, this set back nuclear arguably for years, as folks had this perception of, I do not want a Chernobyl type of event in my backyard. Ultimately, there weren't any fatalities tied to this event. Arguably, the fatalities may have even been secondary in nature because it led to less clean energies effectively being used in the environment. And so in this video, we're going to talk about this deal, why Constellation Energy stock is up roughly around 20% at the time of this video, my thoughts about Constellation Energy, and let's go into, what does this mean? Thinking about the business, this development. This is a very exciting development because I think it might be setting the change in terms of perspective that nuclear should be back on the table, especially if we're going to be expecting, hey, we might have some need for electricity growth in the years ahead. So you can see Unit 1 adjacent to Unit 2, the unit that had been shuttered. Unit 1 previously was reopened in 1985, but was shuttered in 2019 as it wasn't economically viable relative to cheaper natural gas. That has changed because data center consumption is expected to grow exponentially from just a couple percent to 6, 7, 8, maybe even 10% in the years ahead, depending on how much usage is going to occur because of AI. I'm betting that it might be even above this based on where AI is. And you're seeing this not just with Constellation Energy, CEG stock, you're seeing this across several utilities talking about at least 50 gigawatts of data center load growth and demand. So here are various different quotes talking about, hey, we're seeing, commitments and we're seeing requests for expansion and energy. Where are we going to get it? One of the reasons why, just last week, OpenAI revealed their new Model 01 preview. Some analysts are running it through different types of IQ tests, and it shows that this is a step change in terms of knowledge and reasoning, where now you're talking about something that is clearly smarter than humans. And by the way, this is not their next this is a family of models where it's more capable of reasoning, but their next upgrade in terms of the model, going from GPT-4 to 5, is set to happen sometime this winter. So it might be later this year, might happen in October even. So that'll be the even like where you're talking about, hey, if you're talking about 120 IQ with O1 Preview, which has a reasoning capability, maybe you're talking about getting to, sort of superhuman status in the years ahead. So this is very exciting to look at. So looking at this development, tying it back to Constellation. So Unit 1 at this 3 Mile Island previously generated around 800 megawatts of energy, and it's expected to be back in service by 2028. So looking at this, look, Constellation, they've done a good job calling out how they have more clean, reliable nuclear capacity than all the other competitive generators combined. Looking at the different players in the industry, including Berkshire Hathaway Energy, you can see this is a clean energy play. But looking at 3 Mile Island, the contribution, 800 megawatts, and this, deal with Microsoft, it's not like it fundamentally changes the capacity significantly. What you're talking about is, 3-4%, 4 or 5% at most increase in terms of the additional capacity from 3 Mile Island. So it's a little surprising to see the stock jump around 20%. So why is it jumping around 20%, especially when you're looking at a business that this year alone is facing maybe a decline in revenue? So I think there's a couple of reasons why, but you're having this dynamic with Constellation. So let's dive in just a second. First of all, as always, this is not financial advice. And quick plug, recently an Unrivaled Investing subscriber posted in our exclusive Discord. This is a direct quote. "I've recently paid my second annual subscription and couldn't be happier. I've profited enough already to cover the next 20 years of subscriptions. It's not hyperbole. I actually did the math. So if you're looking for compelling ideas, come check out Unrivaled Investing. Rates will be going up soon." So I ask AI Ticker Chat. Chatting now is completely free. So to leverage this AI to learn about your investments, completely free to have this chat functionality. Our premium features still cost, but chatting is free. And so I asked, why are revenues down so far in 2024 for Constellation Energy? And it's actually due to deteriorating power prices. So you're talking about weaker demand than expected. They had some capacity auctions where they're selling off some of their ability to generate power, and it was weaker than they expected, less favorable. And so this is the reason why they saw a revenue decline so far in 2024, particularly in the first quarter. And I think this is one of the reasons why this announcement with 3 Mile Island and Microsoft is significant, is because it may reflect, hey, you're now at this inflection with this business. You're no longer going to be in a period with deteriorating, pricing demands. Yes, solar, doesn't help when individual households can put up the solar panels and then say, hey, what do I need the grid for type of environment. So that is something that hurts demand, but you're seeing this AI demand that may outstrip that dynamic. So seeing Microsoft say, hey, we're going to need so much power for these huge data centers, for these future models that are going to be even more intensive and that are going to ask a lot more questions. For context, when you're talking about O1 Preview, this new sort of family of AI models, what makes it significant isn't necessarily that it's by itself so much smarter than the prior model GPT-4, but that it has the context and awareness to say, hey, you might be asking a tricky question that I might need to break into several parts. So what previously was just one prompt might now turn into 10 different prompts where it says, oh, to analyze a stock, I need to, factor in this question. What's the growth rate? What's the margins? What's the competitive landscape? And so thinking about all these different dynamics when you're analyzing a business. So it gets, it requires many more questions, many more prompts, much more data, much more electricity intensive. And so this is the sort of the backdrop of where we're going. And this, by the way, isn't even the most cutting edge model that will be coming out soon. And so the reason why I think the stock is up so much on this news, even though the capacity is only increasing by a couple percent, is the change in sentiment. Like, hey, this might become a growth industry going forward because of this, this data or this electricity demand. And they're talking about increasing base earnings per share growth from at least 10% to at least 13% due to this deal with Microsoft. And that's expected multi-year growth. This is annually from 2024 to 2030. So that is a nice uptick, saying, hey, an extra 3% growth for the next 6 years. That's a big deal. They're expecting to get a double-digit return on their investments. And this is, I think, another key reason why investors are bullish on this development, is this paves the way for future strategic partnerships. I mean, if you are reopening a plant that was next to the scene of the worst nuclear event on U.S. soil in U.S. history, hopefully knock on wood forever in U.S. history, it does reflect a little bit of desperation. You might even think of like, hey, like we really need that energy. So to say, hey, there will be future strategic partnerships. And, Microsoft's going to be rolling out new models because Microsoft owns a good chunk of OpenAI. What you're talking about is, potentially a lot more of these types of announcements. So maybe it goes from 13% growth to higher over time. So that is a reason that investors might like, to hear these developments. And thinking about, Constellation Energy as a stock, I always go back to free cash flow. Free cash flow is my North Star because free cash flow is what can be spent. Free cash flow is what can be returned to you as a shareholder as dividends or buybacks. I love free cash flow. That is how I prefer to invest. If a company is cash burning, it inherently creates sort of a limitation for how much I'm willing to own, because if you're cash burning, your destiny is somewhat controlled or influenced by the generosity of others. That's roughly a quote from Buffett, picture behind me, where he talked about how Berkshire never wants to be effectively indebted to the kindness of strangers. And so they want to make sure they have lots of free cash flow. When you don't have lots of free cash flow and you're cash burn, you either have to issue equity, issue debt, or work through the cash you have on your balance sheet. So either way, it's not sustainable because you ultimately have to find outside capital to fund your operations. So I prefer free cash flow. That is, my North Star. And so when management calls it out like, hey, $6 billion in free cash flow, it gets my interest. That said, I don't like how they did this slide, but look, they're saying we're going to generate 5.8 to 6.2 billion in free cash flow. I had to look up this term. I saw FCF, which means free cash flow, but then they added like BG, not the BGs. I was like, what is this? So I asked AI Ticker Chat, like, hey, what's this metric? And it's like, oh, that's before growth investments. Okay, so this is a big, heavily adjusted figure. And by the way, this is free cash flow over 2 years, 2024 through 2025. So really, if you're expected to do, let's say, $6 billion in free cash flow over 2 years, then you're really talking about $3 billion in free cash flow, roughly, per year, and that's heavily adjusted before their growth investments. And you can see that they're expected over 2 years to spend about $1 billion in dividends. So that reflects about $500 million a year and about $1 billion per year in share repurchases. I personally don't like to see this as well because normally I do like share repurchases. But if you're going to say like, oh, we're going to spend $1 billion in share repurchases next year, well, that means you're going to do that regardless of if you think that the stock price is actually compelling. I'd rather have management that's opportunistic. Oh, we have a buyback in place, but we're only going to be buying shares if the stock is super compelling. So this does reflect more of a corporate environment than I traditionally like. I prefer the opportunistic type of CEO, the founder led that can understand these concepts like, hey, I'm not going to say we're for sure going to buy back $1 billion next year because there might be better opportunities on the landscape, that they're looking at. And so this at $250 per share, which is where it's currently trading. It may even be north of that. That's around $80 billion market cap. So for $3 billion in heavily adjusted free cash flow, you're talking about a mid-20s, 26 times free cash flow. But it's going to be growing potentially around 13% a year. There's different types of measurements in terms of earnings. So let's just keep it simple and say it's teens type of growth for free cash flow. So you can understand why investors are getting excited about this. The deal with Microsoft bumped up their figures a bit in terms of their growth rate. And, a lot of investors might say, hey, I would be very happy to get a teens type of growth and pay a 20 something times multiple. So I can understand why investors like Constellation. I can understand why utilities have done well so far this year. Personally, though, I just have a hard time. It's not quite right for my own personal journey because when you look at the free cash flow statement, not the heavily adjusted figures, but the actual cash in, cash out, you see a business that has actually been significantly cash burned for the last few years. And it's just such a complex picture. You traditionally, when you're analyzing a business, you look at the operating cash flows and subtract the capital expenditures, like what are your investments in new factories and stuff like that. But the reality is with utilities like Constellation Energy, you have a lot more ins and outs that just make this trickier to analyze. So you lose that North Star of like, hey, it's very clear you have this level of free cash flow. And instead you have to rely on management's commentary of like, hey, $6 billion in adjusted free cash flow the next 2 years. That's not my cup of tea. That's not what I personally prefer. But I can understand why a lot of investors like that. Another aspect why investors might like it is the sense that this is, even if there's a recession, this is the type of business that should be super stable over time. People need to keep the electricity on. So, high degree of recurring revenue. Yes, you do have some debt. Yes, the balance, the free cash flow is a muddy picture and difficult to sort of parse apart. But you can understand why a lot of investors would say, hey, I'm going to get behind this, mid-20s seems reasonable enough for something that's going to be growing teens. My personal pushback is, one is the complexity of the cash flow statement, the needing to raise debt in order to finance things like dividends, which I never like to see. And then there's also the pushback of societal elements where if you ultimately do need to raise rates to cover some of these investments, you always have, like, hey, my energy bill went up so much, I'm going to call my politician. And then the politicians ultimately, these are regulated entities. So, you do have this sort of pushback of, hey, maybe you're getting too good of a return. So you always do have this sort of swing on the spectrum of, where are you in terms of the regulatory landscape that you also have to think about as an investment. So this is, I'd argue, in the too hard pile for me. Wouldn't be surprised, though, if this works out over time because of that teens type of growth and reasonable starting multiple-ish. So if you enjoyed this video talking about this record deal with Constellation and where it could potentially go in the years ahead, as always, stock price can go way higher, way lower, depending on, sentiment, their execution, the end multiple, all these different, will management actually deliver that free cash flow? If you enjoyed this video, I'd appreciate that comment and hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.